Let's talk about the Indian markets with Somnath Mukherjee, who is the CIO and Senior Managing Partner at Ask Private Wealth. Joining me now, thank you so much. I mean, you say that it is a bit of a trifecta for these markets right now. Slowing earnings, high valuation, countered by strong domestic flows. This is a domestic, very challenging backdrop for the market. So what's your outlook now for 2025?
The outlook predominantly is of recalibration of expectation. I think the last 3 or 4 years has been spectacularly good, including the pivot year of 2022 when the US markets corrected by quite a bit. But India held on very, very stable, even in a year when global interest rates went up sharply everywhere. So going forward this year, the trifecta that you referred to that we wrote about, valuations, liquidity, and earnings growth, the trifecta seems to be now edging towards a single pillar direction, which is domestic liquidity being the strongest and probably the only pillar that is driving the markets right now. And given what we have got in terms of market performance in the last 3 years, time for a recalibration of expectation. That doesn't necessarily mean a prediction for a massive market correction or even a very sharp market correction. That I think will require an external stimulus of some sort, essentially a race one of some sort. But certainly returns expectations will be more muted this year compared to whatever we've seen in the last 3 years.
External stimulus. I was just talking to a guest here in the SGX a little earlier in the hour. We're talking about how India, which has been a long trend that we've seen under Trump 1.0, has been a beneficiary as far as the diversification of these markets, manufacturing in the face of these Trump tariffs. Could this continue to provide a bit of a tailwind for some of those sort of export exposed names into the US?
Yeah, so first of all, India is rather less susceptible to export performance vis-a-vis its macro growth, as well as markets performance compared to many other countries in Asia, simply because dependence on merchandise exports certainly is a lot less for India than with many other Asian countries. Second, Trump 1 was not too bad for India, and I think just taking the geopolitical aspect of it, India seems to have got the handle of how to engage with a Trump presidency, and that will most likely stand India in good stead in Trump 2 as well. Global trade is still early days to conclude whether there is a significant drawdown in global trade thanks to Trump 2. If anything, the early signals are mixed, and it's not all gloom and doom at all. And secondly, less of a worry for India. If you look at Indian exports in the last 3 or 4 years, hasn't been great at all. But both the macro as well as markets have chugged along quite merrily on various other levers that really are more material for India.
Yeah, they have indeed. And I suppose, Somnath, in order to look forward, we must understand what happened when we look backwards. And if we look at 2024, I mean, certainly there was quite a run-up, wasn't there? And, there was a big sort of event risk that Indian markets had to take into consideration with that election. And it really seemed to be the tale of two halves. Sort of what happened in the back end of the year, and how does that set us up for asset allocation moving into this year?
Yeah, so first of all, elections seldom have a great impact on market performance. And while it's a great story for many of us, including in the media, to analyze and more often than not overanalyze the event, generally over the last 3 decades, we haven't seen too much of a market impact of elections. So that went on expected lines. And even though the election results were not quite as was being expected by the markets, the overall direction of markets pre and post elections were more or less on expected lines, which is elections are less of a variable, causal variable for markets. Now, what happened in the last couple of months in India in terms of the market pullback after a really good, smart rally for the first 9 or 10 months of the year is simply a sort of precursor to what I mentioned as recalibration of expectations. The last 3 or 4 years has been really and unreally good from a performance standpoint, and the trifecta is looking a little unbalanced right now. On top of that, we also have a scenario where one of the two big levers that has been driving the market for the last 3 or 4 years, one, premium consumption, high-end consumption, and second, public capex. Out of the two, the first one is undergoing a sort of cyclical consolidation after 3 or 4 years of real breakneck growth. And the second one, primarily because of the elections, and not just one general election, but also a bunch of state elections that happened later in the year, um, have gotten disturbed, and it's looking a little difficult for at current run rate for the government to even spend what has been budgeted for. Though things can change in the last 3 months, but as of now, from a run rate perspective, it's looking a little tough. So we have a sort of double whammy where one of the two levers is undergoing a period of consolidation, while the other one, for seasonal tactical reasons, has slowed down, which is government capex. And
So
both of them together sort of is weighing down on corporate earnings. And we've seen the first time in probably 15, 16 quarters that earnings projections are being downgraded. And that's getting reflected in the market. So I would put that as a precursor to resetting of expectations rather than anything that is more radical than that.
got it. And I see you also like the banking and financials, given their compelling value opportunities supported by healthy growth prospects as well and fundamentals.
Right.
Somnath, it's been an absolute pleasure. Happy New Year. Thanks for joining me here on Street Science today. We've got to leave it there. We'll let you get on with your day. Somnath Mukherjee, who is from Ask Private Wealth, joining me there from India today. Let's take one look at these markets.